We're here in Monte Carlo for the Rendezvous de Septembre. For AMBest TV, I'm Richard Banks. And I'm joined now by Jamil Elbahou, Chief Executive of Connect Underwriting. Jamil, good to see you again.
Richard, same here. Thank you for having me.
So it's great to see you back here in Monte Carlo. Last year, people were suggesting it was one of the most important Monte Carlo rendezvous in history. Tell us a little bit about the sentiment that you've identified already this year.
Well, I don't think we're really out of the woods. I think this Monte Carlo is as important as last year, if not almost as important. There's a lot of predictions on what the renewal market is going to look like, so we'll have to wait and see.
So AMBest has got a positive outlook on the reinsurance sector. That's not necessarily good news for the insurance market.
Well, I think the positive outlook helps. I think that with all the continued periphery noise or elements around climate change, AI, cyber, nat cat losses, the influx of capital into the market, I couldn't help but notice it's at an all-time high, apparently, at 700 billion. I think that indeed it is a positive outlook, but it remains to be seen what happens in the next couple of months and what the next nat cat season looks like.
So tell us a little bit about the way that reinsurers are adapting to meet the challenges that their clients are facing.
Well, I can't speak for other reinsurers, but speaking with our own reinsurers and certainly internally from an underwriting perspective, I think, I've said this before, but modeling, proactive modeling, dynamic modeling, I think continues to be the name of the game. Even at an MGA level, I mean, as an MGA, we model our own business within the appetite that we write. Of course, we're an XOL market, FAC XOL market, so we have different underwriting considerations and a different model. Yet, modeling is absolutely the key. And I think I might have touched upon this last year, but a lot of the models that we currently have, I believe, are still need to be updated, aren't necessarily fit for purpose anymore.
Tell us a little bit more about that. What are the areas where there's particular gaps?
Well, you look at some of the losses that we've had recently, including let's say in Dubai, with the floods. That's a market closer to home. So you look at those losses, and I can tell you a lot of the market was absolutely shocked that something like that could occur in a region which has been otherwise considered almost benign is really very surprising. So I think that nat cat losses are becoming more unpredictable. Couple that with inflation, which is still off the charts in my opinion, whether governments admit it or not. And you still have an environment where we can sustain as a market a freak loss that catches everybody off guard.
And on top of that, I guess there are emerging risks as well. How well geared up is the industry generally to address those?
So with emerging risks, and I let's say AI, cyber continues to be emerging as far as I'm concerned. I think there's a lot of unknowns, and I think that the market will need to do a lot of experimentation. I don't believe we truly understand the power of AI just yet. I think we're still far off from being able to properly PML or EML a cyber loss, if you ask me personally. So I think this is all a work in progress. The market, I think, still has a lot to learn about these emerging risks, but we will adapt eventually.
So you mentioned, of course, that you're an MGA. A lot of the M&A activity we've seen has been in the MGA space. Tell us a little bit about your insights on the MGA market in general and what that might tell us about the reinsurance sector generally as well.
I believe MGAs bring a unique proposition to the market. MGAs tend to be more agile. You tend to have a concentration of talent or expertise that is able to shift strategy slightly quicker. And you have a method of effectively starting to solve the acquisition cost problem that the market has had forever in terms of commissions and overheads and all the other dynamics. Supplying capacity to an MGA lowers those acquisition costs, whether or not it appears on the surface. If it's the right MGA with the right tools, with the right strategy in the right market, then I think ultimately the capacity providers increase their margins and lower their overall acquisition costs.
Typically, at this stage of a hard market, you might expect to see new classes of reinsurance startups, as we saw in 2005, 2001. We haven't seen that this time around. What do you think the consequences of that might be?
I think that we will see a round of potential startups. I think that with the ballooning of the capital now in the market, I think there will be people looking to start up new companies. I just think it's a matter of where we are in the cycle for startups. The last couple of years haven't been the best, whether it's been the pandemic or it's been the geopolitical situation, for lack of a better description. But I think that as the market settles into the new norm of a shifting world, I think investors and people looking to set up new companies will eventually surface. I think it's just a matter of time. I think it's the circumstances really that has delayed the new startup market rather than perhaps the market cycle itself.
And opportunities for ambitious young underwriters as well.
Yes, I suppose so. Depends on how ambitious. Ambition these days can be a little bit dangerous, but that's the market we live in.
Jamil, great to talk to you. Thank you very much indeed for joining us.
My pleasure, Richard. Thank you for having me.
For Invest TV, I'm Richard Banks.